Today, what if negative interest rates are coming and they'll be permanent? Hello again, it's Martin North from Digital Finance Analytics. Welcome to the latest posts covering finance and property news with a distinctively Australian flavour. The normal line of argument has been that it's central banks pumping liquidity into the financial markets which has led to falling real interest rates, and that they might indeed take them into negative territory. This is all to do with secular stagnation, reflecting poor productivity, globalisation, weak wages growth, and monetary policy intervention by central banks. And last year, the IMF in a working paper suggested that a cut of 4% or thereabouts would be required to react to a financial crisis similar to the scale of the GFC, and that would pull rates deeply negative. And of course, so far, Sweden apart, no one has found a way back, as Japan and the Eurozone illustrates. Now, negative interest rates are supposed to incentivise spending, and spending is supposed to spur domestic investment and hopefully inflation. But it's not going according to script. Not that there's much of a script. It's such a new and weird phenomenon that there's no mention of negative rates in any of those microeconomic textbooks that might be sitting on your shelf. Negative rates are killing the bottom line of most European banks, and American banks are seeing something similar. Meanwhile, Eurozone inflation and GDP growth are still too low for anyone's liking, and not surprisingly, investors are not happy. And they're getting impatient with Christine Lagarde, the new European Central Bank president. The European market, in fact, took a nosedive during her recent press conference as she stuck with the status quo monetary policy. Those who wanted to hear how Europe plans to extricate itself from the trap of negative interest rates were disappointed. So why should we all look at Europe with concern? Well, because growth among the trading majors is weak, if not in decline. And that's despite the cut policy position of the ECB and the Fed. And by the way, China cut rates in November, so it's not exactly hawkish either. It's becoming abundantly clear that stimulating growth through creative monetary policy has real limitations, and that reality is going to increasingly hamstring central bankers in the future. Many sovereign rates sit in negative territory, and there is an unprecedented $10 trillion in negative yielding debt. This new interest rate climate has many observers wondering where the bottom truly lies. And of course, most economists are on a quest to return to a stable, positive rate eventually, considering negative rates to be there for an emergency and to be temporary. But a working paper from the Bank of England, 8 Centuries of Global Real Interest Rates and the Super Secular Decline by Paul Smeltzing, really puts the cat among the pigeons. This paper creates a long-term global series weighted by GDP from 1310 to the present day, so more than 700 years. The series only includes yields which are not contracted short-term, which are not paid in kind, which are not clearly of an involuntary nature, which are not intragovernmental, and which are made to executive political bodies. In other words, cash lending against annual payments in chickens or other commodities, or against leases for offices, or against jewellery, land or other real estate with no known equivalent cash value are all excluded from their calculations. The GDP weight over time and the share of advanced economy GDP covered by the series varies as history played out and empires rose and fell. Data robustness is an issue, of course, as the paper recognises, as late medieval and early modern data can, of course, never be established with the same granularity as modern high-frequency statistics. One still has to rely on interpolation, deal with the peculiarities of early modern finance, and acknowledge that the permanency of wars, disasters, and destitution since medieval times may have irrecoverably destroyed a significant share of the evidence desired. However, the story is pretty clear. The data suggests that the historically implied save asset provider long-term real interest rate stands at 1.56% for the year 2018, which would imply that against the backdrop of inflation targets of 2%, nominal advanced economy rates may no longer rise substantially above 3.5%. Whatever the precise dominant driver, simply extrapolating such long-term historical trends suggests that negative real rates will not just soon constitute a new normal, they will continue to fall constantly. And by the late 2020s, global short-term real rates will have reached permanently negative territory. And by the second half of this century, global long-term real rates will have followed. The standard deviation for the real rate, its volatility meanwhile, has shown similar properties over the last 500 years. Fluctuations in benchmark real rates are steadily declining, implying that rate levels are set to become both lower and stickier. But downward trending absolute levels and declining volatilities have persisted against a backdrop of a secularity growing importance of public and monetary balance sheets. This would suggest that expansionary money and fiscal policy responses designed to raise real interest rates from current levels may at best have a cyclical effect in the longer term context. According to the report, another trend has coincided with falling interest rates is declining bond yields. Since the 1300s, global nominal bond yields have dropped from over 14% to around 2%. And so he concludes, I sought to suggest that a long-term reconstruction of real rate development point towards key revisions concerning at least two major current debates, directly based on or derived from the narrative around long-term capital returns. First, my new data showed that long-term real rates, be it in the form of private debt, non-marketable loans, or the global sovereign safe asset, should always have been expected to hit zero bounds around the time of the late 20th and early 21st century. If put into long-term historical context, in fact, a meaningful and growing level of long-term real rates should have been expected to record negative levels. There is little unusual about the current low-rate environment, which the secular stagnation narrative attempts to display as an unusual aberration, linked to equally unusual trend breaking in saving investment balances or productivity measures. To extend that, such literature then posits particular policy remedies to address such alleged phenomena. It is found to be fully misleading. The trend fall in real rates has coincided with a steady long-run uptick in public fiscal activity, and it has persisted across a variety of monetary regimes, fiat and non-fiat, with and without the existence of public monetary institutions. And secondly, sovereign long-term real rates have been placed into context to other key components of non-human wealth returns over the very long run, including private debt and real land returns, together with the suggestion that fixed income-linked wealth has historically assumed a meaningful share of private wealth. There is a very high probability, therefore, to suggest that non-human wealth returns have by no means been virtually stable. Only if business investments have both shown an extreme increase in real returns and an extreme increase in their total wealth share could the framework be saved. If compared to real income growth dynamics, we equally detect a downward trend across all assets covered in this discussion. There is no reason, therefore, to expect rates to plateau. To suggest that the global neutral rate may settle at around 1% over the medium or long run, or to proclaim that forecasts that the real rate will remain stuck at or below zero appears unwarranted, as some have suggested. With regards to policy, very low real rates can be expected to become a permanent and protracted monetary policy problem. But he says, my evidence still does not support those that see an eventual return to normalised levels, however defined. The long-term historical data suggests that whatever the ultimate driver or combination of drivers, the forces responsible have been indifferent to monetary or political regimes. They have kept exercising their pull on interest rate levels irrespective of the existence of central banks, de jure, usury laws, or permanently higher public expenditures. It should rather put doubt on the meaningfulness of some of today's concepts. So he would say that negative rates are coming and they are here to stay forever. Now, there's a couple of points here. First, of course, any long-term data series is always going to be subject to significant questions, but I think they've done quite a good job of ironing out the bumps and lumps, and the trend is definitely there. Secondly, of course, a central bank will be quite keen, perhaps, to argue that it's not their problem. They haven't created negative rates. They haven't created the slowdown. It's beyond them to control. So we have to take this with a little bit of caution, insofar that negative interest rates, monetary policy, and central banks are all very much connected. But if this finding is true, and the data does seem to support it, then we seem to be on a one-way street into negative rate territory. And that means whatever central banks do, whatever governments do, we're never going to get out of it. And that thought keeps me awake at night. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again.